So today we're dealing with how to correctly insure a body corporate. Obviously, we're talking about quite an array of issues dealing with body corporate insurance. And we've got Mike Addison from Addsure. Again, Mike, thank you very much for your time. All right, let's get started. The very first point. So what does the Sectional Title Act say? Well, the Sectional Title Schemes Management Act, more specific. I had a quick look about on the Sectional Title Schemes Management Act, and there are three specific rules that I want to highlight that will just explain to you and indicate to you why insurance is so important and why it needs to get done on a regular basis and annually. So the first one I want to look at is a Prescribe Management Rule 17.6J2, and it specifically says approve the schedules of insurance replacement values referred to in Rule 23.3. So they approve the schedules, and that's approved at the annual general meeting. So that would mean that the body corporate would have to have prepared for the AGM schedules of insurance replacement values. Rule 23.3, Prescribe Management Rule 23.3. What does this rule say? It says the body corporate must obtain a valuation of all buildings and improvements that it must insure at least every 3 years and present such replacement valuation to the AGM. So again, this is a requirement for the body corporate and something that they need to adhere to when they have their annual general meeting every year. But the rules say that the valuation has to be done every 3 years. So a body corporate, if they had one last year, it wouldn't necessarily be necessary for them to then present a valuation this year. Obviously, it's their prerogative if they wanted to do that, but they need to then make sure, obviously, that they need to do it in the next 3 years. But Prescribe Management Rule specifically says that a valuation has to be obtained and it needs to be presented at the AGM. And then something other interesting, which I also just picked up when going through the Sectional Title Schemes Management Act, is Prescribe Management Rule 26.1C5 or V. It says that the premiums paid and payment received and the expiry date of the policy must be recorded in the financial statements of the body corporate. So obviously the financial statements are prepared by the auditor. So this is something that the auditor, when they are doing or preparing the audited financial statements for the body corporate, will request from the body corporate trustees or managing agent. But it's just interesting to see that the rules actually require that information to be put into the financial statements. Mike, just bringing you in here, you've obviously been going to AGMs for many, many years. Do you find that bodies corporates renege on these requirements, that it's not presented at the AGM? I know that the auditors obviously do quite a good job by ensuring that that information is there. Since the new rules, what's your experience been in that regard?
Yes, I do see that the auditors are generally asking more about insurance than they ever did before, and they're asking for copies of policies and so forth. So I do see much more compliance along that.
Good. That's like I said, that's one thing that the auditors do play quite an important role with, and obviously they can't present those financial statements if the body corporate's not compliant. All right, we move on to the second question or second point. What does a proper sectional title insurance valuation entail? Now, obviously, the valuation is done by an independent valuer, and as we've just seen, Prescribed Management Rule requires that valuation is done every 3 years. Mike, in your experience, that valuation that you see, because obviously you get involved when a body corporate has obtained a valuation from a registered valuer. How do you see that valuation, that document, in terms of complying with the sectional title requirements? How do you see that document coming through, and what does the body corporate do with it?
I think it's a very important document, and it's very, very useful for the broker. And the more information that is on that document for a managing agent and for the trustees, it can take away a lot of the risks. So if you pass that on to the broker, you're almost transferring some of those risks, because you're giving the broker some more information to provide professional advice on. And if the broker is giving you professional advice in writing, and he misses something, you're almost passing the buck in a way. So I think it's very, very important for a managing agent to have a good, proper, thorough valuation done. That's the short answer.
Mike, just in that regard, I mean, obviously we know valuers, you know, there's you get the desktop valuation, and then you get the valuations that get done where the valuer actually goes to site. And I don't necessarily want to open a whole can of worms with a desktop valuation versus an on-site valuation, but obviously, you know, it's the right thing to do is for valuer to go on site. And one of the reasons why is because the valuer, when he's on site doing a valuation, he actually is walking around and looking at the bricks and mortar, because that's what the body corporate is insuring. They're insuring the replacement value of the property, the bricks and mortar. And if they don't see the buildings that are supposed to be on site compared to what the sectional title plans is, and we do have some other questions that actually relates to this comment, but obviously that's one of the most important roles that the valuer is playing, is that he's going on site with the sectional title plans and looking and seeing and making sure that what he's seeing on site is actually on the sectional title plans, or what he's seeing on the sectional title plans, I think is more important, is in fact on the ground. Do you find that there's that responsibility is being skipped? I mean, do you frown upon desktop valuations, for instance? Do you get that at all?
Yeah, I think generally I would say that a desktop valuation puts you more at risk. Obviously, under COVID-19, we need to do desktop valuations because a desktop valuation is better than no valuation.
Yes, yes, of course.
And believe it or not, Google can give you quite a lot of information, as I've shown quite a few of my clients recently. But yeah, the bottom line is the more information you have, the better. If the valuer has gone to site with his little wheel and he's walked around and he can check square meterages, so I will just give Mirfin a good tick here. We've worked with Mirfin for many, many years. And one of the advantages of working with a valuer who's very experienced with sectional title is that they will know what to look out for. We obviously have had, you know, you usually learn through your mistakes over the years, and after many years of working with a particular valuer, obviously you've come across certain things. So the valuer needs to look out for certain things. It helps both the portfolio manager and the insurer and the insurance broker especially to identify certain things. For example, a retaining wall. I always ask the valuer, please try and look out for those retaining walls. Retaining walls aren't shown as retaining walls on the sectional plan, let's face it.
Yeah.
So if you've just got a sectional plan, you're not going to know that there's a retaining wall or that there's certain risks around the property.
Yeah. Yeah, and again, I'm hopping on the point, but that's why an on-site inspection for valuation is so important. Right, and I think just to go back on the desktop valuation, and I know for a fact that Mirfin, although they offer the desktop valuation service to their clients, obviously it was so important to also say to their clients that once the lockdown, and we're dealing with a specific situation which, you know, nobody's ever had before, is that once the lockdown has eased, or, you know, valuers could actually go out to properties, that they would go back to the property and still do their on-site inspection. And if there were amendments to be made to the initial desktop valuation, that they would then amend that at no cost, obviously, to the trustees. I think Mirfin was really, and I'm hopefully that all the other valuers out there did exactly the same. Sure, Mike, this is I mean, we could probably talk for about 10 hours on this. What are the implications of over and under insurance? And this is such a good topic to discuss. And I'm just going to start, and then Mike, I'm going to ask you to maybe just comment on that. But just one of the things that obviously we see a lot with Mirfin specifically is that where the body corporate hasn't had valuations done for many years, or even in the last 3 years, they maybe haven't had their insurance valuation done. And when there is a valuation done, you then find that valuation is either more than what the current insurance policy is, or it's less than what the current insurance policy is. And unfortunately, the trigger effect, or the trigger response from the trustees would, how can this be possible? And this is such an interesting thing to discuss. How do you deal with that, Mike? I mean, you know, we pretty much, and I know what the answers are, but I think just for the benefit of those people that don't necessarily understand this, and when they're looking at a valuation versus their current insurance policy, what do they need to look at? And what are the implications of having your building over and underinsured? And I guess the underinsurance, I think, is probably the most important one here. Mike, what are your views on this? I mean, you're a broker. How do you deal with this?
Absolutely. I mean, again, we could speak for a long time, as you quite correctly say. Okay, so let's just split them in two. So let's look at the overinsurance first. And bearing in mind that the 3-year cycle is a very good cycle to look at it at least every 3 years. That doesn't mean to say every building. I mean, the very larger risks, I mean, if you've got a R1 billion risk, I would look at it possibly every year with the professional. But ordinarily, for your ordinary 40-unit type of building, which seems to be the average, I would say every 3 years. Now, even in those 3 years, you get overinsurance very quickly, because your insurance policy, when it renews, it will automatically, by default, the insurer will offer you 10% extra sum insured. So your sum insured by default would just increase by 10%. Meanwhile, the building inflation rate was only 5%. Or in some cases, and I'm going back to about 2008, 2009, ahead of the World Cup, the inflation rate was running then at one point at about 18%. And that was for the year on average. Now, there you would find yourself, even if you had a valuation done, you could find yourself undervalued. So first of all, you could get yourself, let's deal with the overinsured first, sorry. So dealing with overinsurance by your insurance company over 3 years, and remember 10%, 10%, 10%, if there's been very little building inflation, you could very quickly find yourself, even having done a valuation, that you're 30% overinsured. Now, what is the risk with overinsurance? Well, you think, oh, well, it's safe, we're overinsured. Yes, you're safe from an insurance risk point of view, but where you could get into trouble, particularly as a portfolio manager, you know that some trustees can be very grumpy. Some trustees, I know there are probably a lot of trustees here this morning, and if the trustees are relying on you as the portfolio manager to look at these things, they're going to be grumpy if you are wasting premium. In other words, if you were paying 30% more, and just say the insurance company would have reduced the premium by 30% had you kept your valuation up to date, obviously they're going to be grumpy. They might look towards you to help. I mean, not that they have the right to, but they might still demand something from you. So from a portfolio manager's point of view, it's fairly high risk. Likewise for the trustees, because the owners will look to you to be dealing with these things. On the underinsurance part, yes, certainly there is a large risk if you're underinsured. So, for example, if you're 20% underinsured and there's a large claim, and the insurance company note this when the loss adjuster does their work, and you're 20% underinsured, in a nutshell, without going into the whole average calculation, basically they will pay out 20% of your claim. 80% of your claim, because you're 20% short on your valuation. So yes, it's critically important, and quite correct. The underinsurance is obviously more of a danger than the overinsurance. It's not a bad thing to be slightly overinsured. I mean, just this last week, we've had a very upmarket complex, a small complex, and we had a very long, about an hour session with the trustees. I think Mirfin did the valuation. I'm not sure, but they felt that the valuation was too low. You know, they were obviously feeling that their places were a lot more, and so they're going to overinsure a little bit. Okay, so there's no harm, but then you just need buy-in from all of the owners.
So, I mean, in short, and I've just got a couple of other comments, is, you know, obviously from the overinsurance perspective is that, yes, the body corporate's probably paying a premium is obviously paying a little bit more for premium, which is still covering the body corporate. But, you know, if you find a body corporate that's in financial distress, then obviously you don't necessarily want to have that situation. But the underinsurance part, as I intimated at the start, is obviously a much bigger issue. And I just want to bring the trustee's responsibility into this, the underinsured policy specifically. I mean, we know that the Act is quite specific, that it's just the responsibility of the trustees to ensure that the body corporate is sufficiently insured. Have you experienced or have you seen in the industry or in the market where the trustees have been taken to task legally where the body corporate was uninsured, and the result of a claim, and obviously this would be quite a substantial claim, where the claim was obviously paid out insufficiently, and that the owners in their rights, which they have, took the trustees legally to court or took them to task. Have you had any experience like that? Or any stories to tell?
We have had, and certainly quite a few close shaves, more than the actual situation. We haven't seen anything go to court, but we actually have seen some pretty close shaves.
So I mean, they would have. I mean, the trustees would have then claimed against their indemnity insurance, which is in the policy anyway.
Yeah, look, I don't want to go into it because get anybody, embarrass anybody, but the situation really is that the trustees are ultimately responsible for it. And the body corporate does indemnify the trustees. So it's more a matter of a very hard look and embarrassment and so forth. Probably I've seen more embarrassments and more awkwardness than actual legal action.
Yeah. Well, I think just to move on from this point, I think the important thing is that trustees need to understand that they have got a responsibility when it comes to the insurance for the body corporate, and something to help them is a regular valuation of the scheme, which they can then use as motivation for why they're approving or proposing the certain insured value for the body corporate. All right, the next point is we're gonna touch on appointing a suitable valuer. What are the important things to consider? So a valuer, obviously we know that a valuer needs to be registered, they need to be certified. And I think one of the most important things, Mike, and your comments on this, because you do deal with a lot of valuers out in the market across the country, is the indemnity insurance, or the professional indemnity insurance that the valuer has to have. And the reason for that is that a valuer can make mistakes. Hopefully they don't do that often. They can make mistakes which can lead to losses for body corporates down the line. And Mike, in your experience, have you seen this scenario where a valuer has made a mistake and the body corporate has actually suffered due to the valuer not doing a proper valuation? And then obviously the knock-on effect from that, not having that insurance in place, the valuer not having that insurance in place where they can then claim from their insurance for the mistake that they made.
Not often, but everybody does make mistakes. Luckily, we pick up the mistakes. It's kind of almost a team effort. I mean, the valuer will go out and do something. The portfolio manager very often knows their building, hopefully, who's dealing with it, and the valuation comes in, and so very often little mistakes are picked up. Oh, but why is their garage there? And especially, we also pick it up because we like to take that valuation and compare it to the plan ourselves and try to understand what has been done. So luckily, a lot of them are picked up. But yes, indeed, there have been some over the years, and you just a lot of negotiation takes place. I haven't actually seen an actual PI payout, but I have seen a professional indemnity insurance payout from a valuer's insurer. In other words, it has never got to that stage certainly on our records. But that doesn't mean to say it hasn't happened. But yes, we've seen action being taken against the valuers where the insurer was applying average and a valuation had been done.
Yeah, it's important to understand this, and I think the important part here is that, as you say, at the end of the day, the insurance broker is going to look at that valuation, and hopefully there's a relationship between the valuer and the insurance broker where where positive discussion can take place. So if the insurer feels that the valuer is not really on top of his numbers for a scheme, that the valuer must be open to reconsidering his valuation. And at the time where the report from the valuer is in fact accepted, and that converts to an insurance policy premium, that by that time there shouldn't be any issues between the value or the insured amount, and in that way we'll obviously safeguard the value potentially for any potential claims going forward. And I think the important thing as well, Mike, is, you know, those potential claims will be when there's big loss. I mean, if an entire building burns down, and the building was underinsured because of the valuation that was presented, you know, I think there's a knock-on effect also on the trustees, as we just discussed. And I think this is why it's so important for the value to have sufficient professional indemnity to cover themselves for every single valuation that they do, not just a blanket cover of 1 million or 3 million rand. And I think the important thing on this is also from a trustee perspective is that, you know, being in the sectional title management industry in the past, unfortunately, you know, trustees, in my view, don't spend enough time when they look at the quotations that are presented by valuers for doing evaluation. The correct questions are not asked. And I think the most important question that is not asked is the professional indemnity. And I think for those people that are present today, if you're a trustee, please just keep this in the back of your mind. When you are asking for quotation, don't just go through the motion of asking 3 quotations and then going with the cheapest guy, because it might come back and bite you and cost you as a trustee. And obviously that's not nobody that's a trustee and that gives up his time wants to be in that position. All right, we're going to have a look at what are the risks associated with using a quantity surveyor or a builder to estimate the replacement value of a complex. Mike, I don't know if you've seen this. I think in the many years that I've been in sectional title, it comes up so often where you know, a trustee or an owner says, "Oh no, but I've got a friend. He's a QS. We'll ask him to tell us what the replacement value of the building should be." Or I've got a builder. My brother is a builder, or somebody that I know very well is a builder. Can't we just ask him to tell us what the replacement value of the complex should be? Have you had any experience with this? And if you had, what have you done to rectify this? Obviously, from an insurance broker perspective, I'm 100% sure that you wouldn't have accepted, let's say, a builder, for instance, giving you an estimate of what the replacement cost of the building should be.
Okay, so yeah, no, very good point. First of all, this requirement to have your valuation done every 3 years only came out towards the end of 2016 with the new legislation. Prior to that, actually the rule used to say the trustees must determine the values. That's all. It didn't say that you even had to have a valuation done. It was only the industry role players like, you know, yourselves and ourselves and so forth that used to really encourage our clients by way of telling them what the risks would be if you didn't have a valuation. So it's a very new, and let's face it, we're only coming in through to the first end of the 3-year cycle now. So in the past, it's definitely been the case. Often a developer / contractor who, you know, builds stuff for sectional title was well attuned to the contracting prices, and very often they used to put the values together. Some managing agents even used to do it, but without the experience. But you know what? It's more formal now. You often do go to meetings where you find a contractor puts up his hand, or a builder puts up his hand and says, "Listen, I could build this building for this." Of course he can, but then there would be no profit in it for him now, would there be? And he's not accounting for the professional fees, the value added tax, and so on. So you often find that contractors, you know, reckon that they can actually give you a fair valuation. But no, it's better to have a proper valuation done by a reputable company, and it's not just reputable because they've got a nice boardroom and a nice office. Somebody who's experienced, somebody who's been out there, and very importantly, as you say, is the PI cover, the professional indemnity cover. On the quantity surveyor point, yes, I mean, arguably the quantity surveyor is very qualified, highly qualified to do bills of quantities. The quantity surveyor would look at it slightly differently. It's still a valuation in the same format which pops out, but they look at, you know, the quantities of bricks you need, the quantities of cement and quantities of all the materials, and they come together with the replacement cost, which is a more scientific way, I suppose, of putting it. Where value will look at, you know, the average rate per square meter. And there's often a debate of whether you should have a QS type valuer or a valuer type valuer. I just want to give everybody, you know, comfort in the fact that I'm aware, very well aware, because I looked at it myself many years ago, to see whether it's a hell of a thing, a valuation qualification. I don't know, I'd rather perhaps do my doctorate in finance rather than try to be a valuer. There's so much, the qualification is quite intense, even though it doesn't look so posh. So I have a lot of respect for the valuation qualification. So I would say that if you've got a proper valuer who's familiar with sectional title, or you've got a good QS that's familiar with sectional title, either would be fine. I wouldn't just use any QS though that's just, you know, qualified at university and he's just slaps together a valuation for you. There is one danger though, and I'm just going to mention that as part of the short answer, and that is that the risk that I see with the quantity surveyor's schedule is the way the escalations are set out. The QS typically would put the escalations within the sums. In other words, the pre-tender prices and the post-tender prices, and then they come out with a total valuation, just say 40 million rand. Now that escalation is included, and nobody really understands. And if he just tosses that valuation forward to a managing agent, and the managing agent or the trustees, and the trustees just give the figure over the phone or via email to the broker, there's a risk that the broker insures that escalation twice. Now on a 40 million building, perhaps not a big difference, but escalations could be 30% of the cost. So you could have a cost of 30% built into your sum insured, and then by default, the insurance company adds the escalations again. And again, you've got a risk of over-insuring just because the format of the valuation was different. And that's pretty important.
Yeah. I think it also stresses the importance of an insurance broker knowing what they're looking at and actually reviewing those reports before you actually go to the market and find an insurance policy.
Correct. And I'll tell you where the risk lies is, let's just say the trustees are relying on the portfolio manager to do this. So the portfolio manager goes and organizes.
Let's hope not.
Yeah, for the valuation. But
Yeah.
I mean, that's why it's very important to get the valuation to the trustees. Let the trustees make the call. It's their building. But the trustees then agree to insure for a certain amount. But you know, if whoever over-insured the building for 30%, somebody could come back and actually demand and say, you were negligent here because you over-insured for nothing. There are the facts on the table. And somebody could be called for to pay that back. I think that's the risk.
Quickly, some questions that we've received in the meantime. I just want to quickly touch on this from Bailey's. The question, the comment was, I have experienced that sometimes the PQs do not correspond between the insurance and the valuer. So we've got an answer from Mirfin on this, and I just want to quickly read it. The PQ in the valuation is based on the latest approved sectional title plan. And you'll note that if you've done any, or if you've asked any Mirfin to do any valuations for you, that you would have seen that Mirfin would have asked for the sectional title plans, and it's an extremely important document to present to them. Any variation from the plan is an indication that the sections concerned may have illegal alterations or extensions which are potentially uninsurable. We recommend that you apply to get the sectional title plans updated and ask your insurance provider to verify the insurability. And I think, again, it speaks to the comment that we had before, where it's so important for the valuer to go on site with the sectional title plans, because they will pick up what is on site and what's not on site, and what is on the plans and what's not on the plans. So Bailey's, I hope that that answers your question on that.
I can make a comment on that, Lee. There's actually another element to it. Or some valuers, and I even suggest to them, listen, just use the figure that's shown on the PQ schedule or the sectional plan, because the PQ schedule measures the wall from the center of the wall to the center of the other wall. But yes, you do have to look out for anomalies, for extensions that aren't shown on the plan, etc.
Yeah, another quick question, which maybe touches on this as well, is from Carl. Carl said or asked, I will appreciate Mike's opinion on the PI liability of the valuer for when they get it wrong. So we do have an answer from Mirfin on this, Mike, but you can add on to that. It says, the answer is the valuer must offer adequate recourse to match the size of the complex to be valued. This must be backed by professional indemnity policy. If a valuer does not stand to be held accountable for the valuation, the liability for the shortfall in claim payout is passed on to the trustees. And this is why we touched on the trustee responsibility and the cover that the trustees automatically have in their policy versus that of the valuer. Why put yourself at risk for the sake of saving the body corporate a few rand? So the important thing, the important answer here is the offer, the adequate recourse that the valuer offers in his service when he provides that. What is your view on this question and answer, Mike, on the PI liability for when a value gets strong?
Okay, so I think first of all, just understand that the PI cover doesn't mean that the insurance company of the valuer will just fork out, the difference. The PI cover, believe it or not, is just like or any other indemnity cover, liability cover, or in other professional. It's actually there to protect the insured, which would be Mirfin in this case, or the valuer. So if he's got it wrong, certainly they would seek a settlement. But they may, if the valuer hasn't really done anything wrong, but was fed the wrong information by the trustees or for whatever reason, you could well find that the PI cover would defend the valuer. But definitely, I would work with the valuer. One of the tick boxes in choosing your valuer is to make sure that they do have a professional indemnity cover. It's I'm actually quite worried about the number of valuers out there without PI cover. It does worry me.
It's Again, I mean, I can't emphasize this enough. The trustees need to look at that when they get quotations from valuers. Does the valuer need access to all units in a complex? That's the question. And how does the valuer deal with upgraded units versus standard units? And this is quite an interesting topic as well, Mike, because what you do find is that obviously the valuer can't get access to every single unit. I mean, you can imagine specifically in the Gauteng area, complexes of 300, 400, 500 units. There's just no chance that the valuer is going to get access to that. So how do you deal with this? What is your expectation from a valuer's report when he reports on the valuation that he believes the building should be insured for? What is acceptable in the industry?
The expectation is, and then this is the norm, and we are obviously all well aware of the fact that every complex has got different dynamics, but the norm is that the valuer would value per the standard finish of the developer. Okay, so if you looked at a normal 40-unit complex, what would the standard finish have been? And the expectation would be that the valuer did try to at least gain access to one or two, maybe three, but at least one that that is the standard type of finish, to get a feel for the standard finish of the sections, and then clarify that. Even at the AGM, you can say that the valuation is based on the standard finish, and at the AGM, you would say that if anybody has since improved it, especially the very older complexes, things have changed dramatically over the years. You say to people that this is based on the standard finish, so please, there's an additional sums column for us to add your latest improvements. It only costs about 10 Rand per, I always say, and this is the worst case scenario, usually 10 Rand per 100,000 Rand extra cover. So you always tell the owners, for shortfalls, just give us the number and we'll add it to the insurance for you in the additional sums column. But absolutely, to answer the question, the short answer is, about get a feel for the average developer's finish.
Yeah, no, I think the important thing here as well is that, you'll probably find that the majority, and this is just a generalization, is that the majority of units are generally still, the stock standard units as they came out from the developer. And then you might have, a handful of owners that over time maybe have renovated their apartments, and put in fixtures and fittings that are obviously much more expensive than the standard one. So instead of penalizing the majority of the owners for the upgraded sections, those owners that actually do have the upgraded sections can still insure their units for more than what the body corporate insures that. Just a quick question from Antoinette, Mike, obviously directed at you. Should or can the body corporate insure structures on common property that is not on the sectional title site plan? And how to deal with these structures when insuring? I mean, obviously the answer is yes, but just quickly, when that happens, I'm sure there's 10 red flags that go up and questions get asked immediately. Why is there a structure on common property that's not on the sectional title plan?
Well, the sectional title plan is, it's almost looks like a very rough drawing of the main buildings, and it identifies the common areas and so forth. And it certainly doesn't show swimming pools and boundary walls and all sorts of things that it's not a building plan, it's a sectional plan. It's to identify, sectional plan identifies sections and common properties and common areas per se. You could say that's what it's about. Yet a lot of importance is placed on it. If you look at the definition of a building, it actually says in the Sectional Titles Act, the building is actually defined as that which is actually on the sectional plan. Whether it's actually there or not, it's a very strange definition actually. And the definition of an insurance policy is somewhat different. So in fact, you could have something on the sectional plan that is wooden, okay, for example, wooden or a different structure, but you'll go to the insurance definition of a building and it's actually not even insured by definition, because an insurance by default won't insure a wooden structure automatically. So you've got to be very careful. You've actually got to look at both the insurance definition and the sectional title definition. Now, having said that, what's very important is that all improvements to the common property need to be insured. Funnily enough, the new rules don't say that, but the old rules used to be very specific on all improvements to the common property. But we take it that it's supposed to be there.
There's a question from Shelley. Do you believe that the managing agent needs to provide info on boilers, lifts, generators, etc., when requesting the valuer to go to site? So I think to start off with that answer, the valuer doesn't necessarily know, the site hasn't done it before, and it would be important for the valuer to get all that information before going on site. And yes, he might well pick up that there are these things that he's seen on site. But yes, the answer is that he must definitely do that. Anything that is insurable under the building's policy needs to be pointed out to the valuer when he goes to site. Right, when the trustees receive the valuation from the valuer, what should they do with it? And Michael, this is a very, very important topic as well, is because a lot of trustees, they get the valuation, they probably just scan through to the sum insured, and then they say, well, this is overinsured or it's underinsured, or how can this possibly be? And then, what we do see is that when the valuer says, well, the building should be insured for 100 million, but the current insurance policy is, let's say, 120 million, then they immediately say, but the value can't be right. What do the trustees actually need to do with this valuation report once they've received that?
Okay, so the very short answer is get it to the insurance advisor or broker as soon as possible, so that the insurance broker can. You see, this is one of the important documents that in terms of the Phase Act, which is the Insurance Act, the Insurance Advisory Intermediary Services Act, is that the broker needs to base his advice on something. And so this is a very, very important part of the advice process. So get it to your broker so that he can start providing advice. Now, very typically now, it is actually a thing of what not to do. Okay, so you get what's happening now in this present cycle is because the inflation rates have been pretty low. Let's just say 5% over the last 3 years, 5, so 15%. Yet most people who had a valuation done 3 years ago will find that they're now overinsured. So the difficulty that you have is working out whether to immediately reduce the value or to wait until the next AGM. And that's another discussion point. I don't want to delve into that too much. In fact, I won't delve into it at all. But it's a very important point, because the danger is that you drop a value now when the last AGM, somebody has been relying on that higher value. So you've got to be careful on how you deal with it. That's all I'm saying. So get the value to the broker and look at it very carefully. Don't just react.
Mike, I'd like to just, somebody asked, Peter asked, or he made a comment. He says that the insurers should automatically offer escalation at the current building inflation rate. Do you agree with that? Is that something that you believe the insurance company should provide?
Yeah, it's a difficult one. They're working on about 10% now, because you see the building inflation rate, you know, what is it at today? Because we don't know what it is exactly today, because those figures come out after the fact, as Bjorn from Mirfin will well know. It's quite difficult to try and determine. So to be conservative, I mean, they say, oh well, it's 8%, so let's work on 10% for the time being. And you'll remember when we had that period of time when in 2008, when the inflation rate shot up, and it shot up a lot because of the demand on construction ahead of the World Cup, and the steel prices went up and all sorts of things around the world, and the steel being a major component, etc. Now the insurance, what happened there was over a 2-year period, people suddenly, even though they were having their valuations done every 3 years or so, they were finding themselves in an undervalued position. So the insurers moved it up to 15% for a couple of years to compensate. So they do try to do it, but it's a very, very blunt way of doing it. It's not actually up to the insurer. The insurer don't even need to increase the sum insured at all. It's actually up to the body corporate to say. Now, having said that, the important thing is your policy renews annually. The trustees actually should be choosing what the new sum insured should be. If you're getting proper advice and you're dealing with it, and that's another whole hour's discussion on how to deal with your policy renewal and take proper advice from your broker, you should be looking at it properly. I mean, there's just one we signed off yesterday where we're not increasing the sum insured at all. You know, we spotted the fact that it was unnecessary, given the fact that the buildings were slightly over-insured. It's actually up to the insured to tell the insurer, no, don't increase it by 10%. 10% is just the safety net.
Another question from Caroline. Is there a risk of equal replacement value assignment to primary and utility sections according to PQ?
Okay, so the primary is the residential part and the other one is the storeroom or garage or what have you. So yeah. What is the risk question there actually? What is the risk?
Is there a risk of equal replacement value assigned to that?
Yeah, there could be. So
if the garage is the same replacement value as the utility section?
You know, if the valuer has done his job properly, you won't have that problem. And some of them are dealt with differently. So very often you find that a garage and the residents are all shown under one section, section 1 or whatever the case might be. So a valuer would normally say, well, it's 10,000 Rand a square meter for those that 100 square meters, and I'm going to use a rate of say 5,000 Rand. I don't know what it would be for a garage today, but just depending on the type of finish, I'd work out 5,000 Rand for those 40 square meters, and they might apply an average rate for that 140 square meters. Others will just split the two rates and show it on the plan accordingly. Different ways of dealing with it, but professional valuers usually deal with it properly.
What if a valuation is done, but owners at an AGM decide that it is too high and all agree to rather keep the sums insured down, or obviously insured for less than what the valuation was done? What is the risk here?
Oh, that's a very good question. And that often happens at AGMs. Somehow or other, it's always the Saturday morning AGM statistically where that seems to happen. I don't know why. So, yeah, and we could spend another half an hour on that. Yes, there is a risk of that happening, and it shouldn't happen. if a valuer has valued a building for X, but now the owners want to reduce it, actually that would be against the law, really, because it actually states in the, let me just see if I've got it here, section 3, insure the buildings and keep them insured to the replacement value thereof. Now, let's face it, if a valuer, a professional valuer has valued the building, there can be nothing closer to the replacement value than that. So if you disagree with the valuer's value, you should get a second opinion. Go get another valuation done if you're not satisfied with it. But you would be actually in transgression of the act itself, not even the rules. You'd be in transgression of the act. And I don't believe that owners at an AGM have even the authority to do that.
Another question, what if the valuer finds additions and or improvements not shown on the sectional title plans? How can this be and what should be done? I think we kind of touched on that already. Another question which also speaks to this question from Caroline, are insurers permitted to insure extensions which are not approved by a special resolution of the body corporate and not on the registered sectional title plan? So two things here, what if the valuer finds additions and or improvements? And can the insurer actually insure something that's not on the sectional title plans? I think it's a very good question.
Absolutely, and there's a lot of opinions here, and you know, you can actually, if you read all the textbooks, you'll have one answer, but if you look at the practical way of dealing with it, it's the other answer. I lean towards the practical way of dealing with it because it's so rife and common out there. So whenever you go to a building that's been around for about 20 or 30 years, you will find extensions, and you won't find them on the sectional plan, and it's just there. And it's been insured as part of the buildings. There's never been a fire or a big problem there, so it hasn't been an issue. Yes, when the fire comes, it could be an issue. So what we, and very likely will be, insurers always say, oh, no problem up front, but when it comes to the fire, then all the ifs and buts come out. So rather identify them. So all you do is you identify them and you advise your broker that there's an extra 20 square meters that's been extended here, or whatever the case might be, that's not shown on the sectional plan. And it's very simple. You go to the insurance company and say, listen, here's this extra bit. Can you please note it on the policy that section 5 has got a 20 square meter extension, and they note it on the policy. The insurance companies are saying, if you don't ask, you don't get in insurance. So you always ask the underwriter, can you please add this? And they normally add it. They just add it, say noted, you know, section 5 has got a 20 square meter extension. There is a condition in the policy, believe it or not, that says that it's part of the compliance parts of the policy. You know, your condition of cover, I should rather say, one of the conditions of cover normally is that there are registered plans for such buildings. But yeah, but you know, if they've acknowledged that it's an extension and that it's there and that they're covering it, I think that's 99% of the way through.
I think the important thing here as well is that, you know, if they are unauthorized or unapproved extensions to the scheme, well, then the body corporate's sitting with quite a big problem, because somebody's getting the benefit of an extension, they're not paying a levy for that, and actually to the detriment of the other owners who's actually subsidizing that. So I think that in itself is probably a discussion on its own. It's a can of worms that get opened, and there's just so many other things that need to be considered and dealt with when that actually happens. So I think for those trustees that are aware of these scenarios or have had that in their scheme, I think it's really, really important to deal with this properly, because it means that your scheme is not 100%, and that needs to be addressed with the owner who's done the extension, etc., etc.
Lee, can I make one comment there quickly? Very quick comment. It is such a common issue. I mean, just about every second valuation that we look at has that problem. Such a conundrum for the trustees, because it's an expensive exercise to fix. So it often gets just, leave it for now, yet it's so important. And I'm just going to mention here, see Zelinda is with us this morning. Something which Zelinda has, and ourselves and the financier have been working on, is that trustees should consider speaking to and having it packaged, there's a way of financing those things correct. That's all I'm going to say.
Well, that's quite worrying to hear that, Mike, to be honest. And I think, you know, it's so important again that owners or bodies corporates as a collective appoint the right people to act as trustees, and that the trustees take this responsibility on, you know, with the responsibility it requires, and these kind of things are dealt with properly. Because, you know, what I've seen in the past is body corporates, they ignore it. They don't want to go through the rigmarole of getting it done. And it just goes on for years and years and years. And every single year it comes up at the AGM, it's not dealt with, the owners get upset, and it's really not a good situation to be in. So I think the best medicine is to actually deal with it immediately. I just want, yeah, sorry, Mike.
So it's another hour's topic. So I think it's best, I was going to say best to move on, but it's a very serious topic.
Yeah. So just, we had a question from Shelly that I just want to quickly address. Shelly asked, what PI limit do you believe is adequate for the valuer? Ideally, the valuer must offer recourse for 10% of the scheme's total replacement value. So obviously if the replacement value is 100 million Rand, then the valuer should offer recourse of up to 10 million Rand. Sectional title valuers should hold at least, so we're talking about the sectional title valuer, should hold at least 20 million Rand professional indemnity, which should be adequate for smaller complexes. Since professional indemnity insurance also covers the valuer's legal expenses, a safety factor of 2 is recommended. This means if the valuer offers recourse up to 20 million, this should be backed by professional indemnity policy of around 40 million Rand. And that's quite a big important decision for the trustees to consider, to make sure that the valuer actually has this insurance. And I don't think, Mike, I mean, in your experience, and I don't believe that actual trustees know what the requirements are for the valuers. And this is a very good question, Shelly. Thank you for sharing that with us.
Okay, so my comments would be, and it's not just because this is a Mirfin presentation, my clients very well know that my position with Mirfin is Mirfin is very much the benchmark for valuers in the country as far as sectional title goes. So there you go. I would follow Mirfin's Mirfin's figure there. I think it's very, very well put as a guideline. PI cover is very difficult. A touchy subject sometimes, because sometimes it's difficult to get PI cover. And it's not that the business is bad or anything like that. And I'm talking generally now. It can be whether it's a doctor or a managing agent or whatever. The problem is that to get the reinsurance internationally for that is sometimes a pickle. And there are actually not so many PI insurance providers in South Africa. There's a very few. So if you just understand, if you're dealing with somebody that's got PI cover, it's a huge tick in the first place. And then you look at the amount, of course, that is helpful. But you must also understand that, you know, if you've got a billion Rand building, you can't expect the valuer or the insurance broker or the managing agent to have $1 billion worth of PI cover. The premiums would be more than their annual turnover. So it's got to just be a reasonable amount.
Must an HOA also do evaluation every 3 years?
I spotted that question. Very good question. It's actually not stipulated anywhere. The CSOS Act only refers to fidelity cover in terms of insurance at all. I mean, I don't see anything else in the CSOS Act about insurance. However, you know, maybe their MOI documents or their constitution would say something about that. I have seen constitutions where they've pretty much borrowed or cut and paste some of the bits and pieces from the Sectional Titles Act in the old days, but bear in mind again that the old act didn't say anything about valuations. So officially no, but the big but with capital letters is, I believe an HOA's valuation is very important. It's often overlooked because there's a lot of small HOAs which just basically have a gate and a boundary wall. That doesn't matter. I've seen some huge problems where the HOA has not had a valuation done. So I strongly recommend that HOAs follow the same.
Mike, just some questions that we came through, and this was quite an interesting one. This is a scenario that somebody sketched for us. I'm just going to quickly give the scenario, and it's got to do with when a body corporate has submitted an insurance claim, but one specific owner in the scheme was found to be negligent. So what I'm going to deal with is the electrical certificate of compliance. All the owners in the scheme have got an electrical compliance certificate. One of the owners believes that he's a pretty good handyman and he attends to his own electrical work. So what happens is that he does not get a certificate of compliance. Suddenly there's a fire and the entire scheme burns to the ground. Can the insurance repudiate the entire body corporate claim on the basis of the negligence of that one person that wasn't compliant?
Okay, so if I'm understanding the question correctly, the owner who reckons he's the best electrician in town, but he's not, he fixes his own DB board. There's a fire in his section because of that, and now he's burnt the whole place down. Am I understanding the question correctly?
Well, the building burns down. It's not necessarily because of what he did, but the whole building burns down, and he obviously hasn't got a compliance certificate, and because of that, can the insurance repudiate the entire claim?
Okay, let's give two answers then. So the first answer would be if he had done that and the whole building burnt down and it was found that he was fiddling in his box. If it had nothing to do with the claim, well, then they would have no issue with paying the fire claim anyway, because it wasn't related to the cause of the fire. The fire might have been caused by the hairdryer that was left on the bed.
Okay,
but if in fact, the second thing is obviously if he's caused it, in other words, the spark happened because of his poor sparky work, the insurance company would most likely reject, and this has never happened. I'm just speaking for what the insurance companies have reacted on this type of question before, is they will not necessarily pay for his damage, fire damages in his section, but they will be obliged to pay the rest of the building because you cannot prejudice the other owners on that basis.
Question that we had from Hazel, she asked if the common property is part of the building's insured on the valuation and the insurance policy. I mean, obviously we know that it is, but I think it's important here, Mike, because obviously I've seen your insurance, breakdowns of schemes. Just maybe some information on how you do it from your side, where you actually stipulate per line item what the entire scheme is insured for, obviously, which includes the common property.
Yeah. Okay. So it is a very good question. And again, it's another half an hour, so we'll keep this one short. So remember that you can't really, and I always say there's a few analogies I use. One of them is it's very difficult to unscramble the egg. Okay, so once an egg is scrambled, it's scrambled. And likewise with the building, you've got a building and it's got units, and the units are sections and common property, and we all know that you've got an undivided share in the common property. Now the common property actually starts halfway through the wall and halfway through the ceiling. So hell's teeth, you can't really say that you're going to split the common property, really. Okay, so just understand that part. So you can't really split it because the building is valued on a rate per square meter. 10,000 rate per square meter will include, the inside half of the wall and the outside half of the wall. Okay, so let's get our head around that. So when I speak about common property, I speak about common property items being separate. And that's quite a good exercise to do. So for example, the parking decks, you might be 3 parking decks under the building. The building has been, or next to the building. So the parking decks would be the common areas. Then you might have a squash court. You might even, you could have very expensive other common area items that are not part of the building rate per square meter per se. So those items, I always say, I ask the valuer to list them separately, and Mirfin does that very well, because Mirfin and I were speaking on how to set these things out 15, 20 years ago. So we set them out separately, and we identify them, and then we even have a column for them, and we split. When we actually show the schedule of replacement values, it's nice to have a common area column making up the section and the common area equals the total unit sum insured. And the reason why that's quite important is so that the owner can actually ascertain whether that 10,000 Rand a square meter was enough. In other words, it's not all lumped in his rate per square meter, if that makes sense. And that's the short answer.
Thanks, Mike.
There's a lot more to it than that, but I think
yeah,
it's a time constraint.
No, yes, it's time constraint. But I think the short answer for Hazel is that yes, it is included, and the insurance policy should have a breakdown of that to indicate, because I think the question that we had before is that if you generalize the replacement value, that you might find that people think, well, why are we insuring the garages for the same value as the units, for instance? Maybe touches on that as well. Just one or two other questions. There was a question also from Hazel. Tenants, fixtures, and fittings, are they valued by Mirfin? They're not valued by Mirfin when they do the insurance valuation for the property, but it is a service that Mirfin offers independently. So any owner who wants that can deal with Mirfin separately, but it's not part of the insurance replacement value of the property. And then there was another question from Hazel. Once the valuation has been done by Mirfin, do they advise the broker of their findings? Yes, that valuation report goes to the managing agent or the trustees, and then the trustees, that valuation should then go to the insurance broker, because if the insurance broker is going to go out to the market to get an insurance policy, then it should be accompanied with that valuation report. And I think during the session, we've already touched on, the communication between the insurance broker and the valuer to make sure that they actually arrive at the right insured value for the scheme. So this is quite an interesting one, and it's, I guess it relates more to Gauteng than the Western Cape or KwaZulu-Natal, friends, or anywhere else in the country. It's got to do with dolomite insurance. Very interesting question from Daniel. Daniel, firstly, thank you very much for this question. We found it extremely interesting, specifically myself in Cape Town, where I don't know, what is dolomite? I'm joking. So we posed the question to Mike, and the questions, it's a 4-part question, but I'm just going to quickly read it. Mike, if you can try and give us a shortened answer, that'd be fantastic. What is the body corporate's responsibility for dolomite insurance? What are the procedures to get the body corporate insured for dolomite insurance? Are there prescribed reports required from engineers for the dolomite insurance? And then lastly, are there any other specific considerations applicable to dolomite insurance? And I know you've done some work on this, Mike. What is your interesting point?
To be honest, I try and avoid dolomite areas myself because it's a lot of hard work. No, I'm only joking. It's a very difficult one. If you look at each policy, that's typical sectional title policy, you'll in fact find dolomite is excluded flat. So dolomite is not dolomite related properties. Whilst they'll insure the buildings, they're going to exclude dolomite related subsidence, because it all relates to subsidence. It's when the building sinks into a hole type of thing, or the building starts collapsing because of dolomite problems. So it's an exclusion generally. Most of the insurers will not. And then there's the question of, well, how can we get it insured? And you go through all of the report process. And I mean, these reports can cost 60,000, 100,000 Rand, depending on to the extent of the report. And then you present it to the insurer, and the insurer says, no, we're still not happy. So it is a very, very difficult problem. We've been looking at it because, I mean, I joked just now and said that we avoid the areas. In a way, there's a little element of truth in what I was saying there, because it's nothing more awkward for a broker to say, yeah, no, let's do your business, but we can't help you on one of your most serious risks. So we actually are talking, there's one underwriting manager, and I've actually spoken to the CEO of another company, where there are movements towards perhaps putting together a fund where we can try and do something very much along the lines that Addsure was done in the old days. 23% or 25% or so of Gauteng is in fact dolomite area, just more so in the Pretoria Centurion areas and some of the other areas. So yeah, it's a challenge. Is that
Yeah,
is that the short answer? Is there
yeah.
any more than that?
Yes, thanks, Mike. Yeah, I
Yeah.
know that we obviously spoke earlier in the week, and you did say that there was, it's not there's not really a short answer to it, but I think, um, with regards to Daniel, Daniel, if you are still part of the Zoominar, you're more than welcome to contact Mike directly, who can address that with you. For future use, and I'm assuming this relates to your specific scheme. Louis, it relates to an HOA. What happens if an HOA fire hoses are not compliant and a fire should occur? What happens to the insurance for a private house? So an HOA is an estate. There's probably little common property where there is fire hoses, but let's assume for the minute that there are fire hoses. They're not compliant, they haven't been serviced, and a fire breaks out. What happens with that insurance? Give us an idea of what the insurance company will go through when they assess the claim that's now been submitted to them.
Okay, so it's actually I was just thinking now that there's a question deeper within that question actually, but the short answer again is that the individual houses in an HOA are not covered by the HOA ordinarily, or 99% of them not, because they're individual urban. They're individual properties. The individuals have arranged their insurance with their banker or whoever else they may have insured it. So it's only the common areas of the HOA that would be insured under the policy. And that would be could entail quite a bit, and it could entail the boundary walls between the properties, or certainly the boundary wall of the whole property. So that's why it's good to have a valuer value the HOA to determine what is and what isn't insured. But ordinarily, the house burns down, owner's problem, because it's his house or her house. That's the short answer. Okay. When I say there's a question within the question, there could be some liability issues, because if the fire equipment in the road wasn't serviced and had no pressure, whose fault would that have been? So that's the question within the question that I was thinking of as you asked it.
Yeah, I think what it relates to is that, sorry, in an estate, you might find that there's a clubhouse, there's a pool room, there's a pool, and that specific building or structure does have a fire hose reel, and that would fall under the HOA responsibility. So I think what you're touching on is that in that case, there would be a liability on the directors or the trustees of that HOA, and there you might find that the HOA is short of that insurance claim, and that the insurance might decide to repudiate that claim. All right, guys, I think we way over our time. I just want to thank Mike from Addsure. Mike, thank you very, very much for your time and for your valuable input. I think it's, like you say, we could probably be chatting till 1 o'clock today on all these items. Wow. For those people that have joined us today, thank you very much. Thank you for your time, and thank you for the questions. I just want to close off. Remember the Insure 15 promotional code that it's for valuations and for 10-year maintenance plans, and it's valid till the end of this month. So please, if you do ask for a quotation, please use the code and you'll get the 15% discount. If you want to book a free maintenance, repair, and replacement plan training session with Mirfin, please email Amy at mirfin.co.za, and Amy will set up that free training session for you with one of Mirfin's qualified people. So that brings us to the end. We hope to see you soon at one of Mirfin's Zoominars. Thank you very much, guys.